The purpose of this session is to make the clients also understand that they have no disadvantages in the present scheme of things, because till a couple of months back the margining system was different, and in a very graded manner the margins have been increased significantly, and come September I think we are going to have 100% margining. So it doesn't matter whether you are going to do a position trading or whether you are going to do an intraday trading, right? So the only difference that you are going to get is not to take an overnight trade. So the difference that is going to segregate an daily trading, intraday trading and the positional trading is the overnight risk is eliminated. So previously it was not like that. Now even for 10,000 rupees a Nifty futures could be traded, because 10 times, 15 times exposure could have been given easily. But right now that is not there. So probably the customers feel that they don't have that much of capital and probably can make some of them withdraw from doing the trading. Okay, even if they are doing profitably, because of the lack of capital or lack of exposure margin which they will have from now onwards, they may feel no, it is they are unable to do the trading activity. So what we should do is that we should highlight to them that in the present scheme of things, it is almost a status quo like what they had some months back. That is, even with a lower capital, whether it's going to be for position trading or whether for the intraday trading, you can do that. So what we are going to do is that we are going to make only a shift in the segment. See, now the first understanding, easy understanding for most of the newcomers or even for traders is a cash market. So they understand the cash market well, because the way they buy and sell is now buy one share of Reliance or 10 shares of Reliance and sell it, whether it's an intraday or whether it is for positional trading, probably invest some amount and then sell it. So that cash market, very traditionally they have understood the heart of trading cash market and also the capital outlay. So those who used to take delivery will normally have the capital, and that particular capital had to be previously in previous periods and all had to be deposited within T+2 days, but nowadays it has to be there upfront. So the amount will be debited before a share is bought. Now the same thing is going to happen as far as whether we are trading cash market or whether we are going to do futures in equities or commodities. So the moment a trade is entered, it will check whether the required amount of cash is there for buying the share or whether the required amount of margin is there for trading a futures. So suppose if it is Reliance, somebody wants to buy 50 shares of Reliance. Now 50 shares of Reliance now will be say 2,100. So they need to have maybe a lakh and odd rupees, right? So 1 lakh rupees plus in the account, and that amount only if it is there, then the share will be bought. Okay. So now till now for intraday trading, probably for 1 lakh we might have told them that no, even if 20,000 rupees is there or 10,000 rupees is there, you can buy the share, and by 3 or 3:15 the trade had to be closed. Otherwise the full amount of money has to be paid for carrying it over. So that is the present system. Now we are moving into a system where the entire amount has to be there, right? So the client may be shy of trading such a huge amount of capital outlay. So the purpose of this is basically tell the client that you don't need that much of 1 lakh. Okay. So you can go with the same 10 or 20,000 rupees as you used to go before. So there is the one advantage for them is the lower outlay for the same amount of risk reward appetite which they used to have previously. And second thing is, by going into the option, the second biggest advantage is the risk is cut down only to the option amount that is paid. Okay, so that is another advantage. So the present system brings advantages rather than disadvantage. So we have to get ourselves convinced that it is advantageous for us. It's not that we are trying to only market it. See, even otherwise also, these things should have been adopted even some months and years back. The investors themselves must have found out what is the more efficient manner of trading and whether they should have been in futures or whether they should have been in options. So anybody who wants to rationalize their capital or who wants to make efficient use of their capital, cut down the risk and probably look towards higher return on investment would have definitely considered option trading more than futures even before. Now, the way the futures was understood was very similar to the to the cash market, and hence they had an easy understanding, so they used to do it in futures, unmindful of the amount of capital outlay that was required. But right now, they have to only have one shift of understanding, that is, the lower amount of capital will come with an appreciation of how to use options for trading. So our entire endeavor is to tell them that please consider options as an alternative investment asset rather than futures, and what advantages it holds. Now, in this session we are going to show you that what is the outlay that is required for futures, what is the outlay that is required for option. We are also that is going to be in index as well as in equity and commodity. Also, we are going to show that what is a spread contract and how the option spread contract minimizes the requirement for capital. And third is how to execute a spread strategy in a very efficient manner. So this is the objective of this particular session. At the end of the session, you can ask questions, and the entire purpose of this session is to enable our managers, is to enable them to tell our clients that this system is advantageous. So the question is that we should not be on the back foot. We should be on the forefront to tell them that look, whatever that has happened is to your advantage. So for us also, the business should not suffer, and at the same time the client is also safe and gets a higher return on investment. See, potentially compared to futures, if options have been traded in a proper and efficient manner, in a way, if it is understood properly and traded properly, then the return on investment in options for the investment is much higher than the return on investment in futures. We are going to show with some live examples so that you can convince yourself, you can convince the customer also. Now, I think in the case of derivatives, I'm not going to the cash market. So now we will look at first the futures. Then as time progresses today, we will also look at how probably those who want to be in cash market also can use options. Now, in the case of a futures, what is the first thing that comes to your mind? See, any trading plan has to have some important components. What is it? Is it a trend identification? We are talking about from the technical side. So fundamental analysis is different. Probably they will look at the brokerage house's recommendation, their own analysis, and the balance sheet analysis, then about the industry, the competition there. So based on all those things, I think there is some way of picking up stocks based on delivery volumes, based on what the mutual funds are doing. So that is one set of investment. That is fundamental. And second thing is, of course, people who are going to mutual funds do SIP. So that's a question of investment. Now the question is that for a trader, looks at a technical analysis or probably a statistical analysis. So, but any trading plan definitely needs to have trend identification, whether the trend is up or down, right? So this is the first portion. Then second is go along with the trend. Go along with the trend. So where to buy? So I understood where the trend is, so where to buy. Then third point is profit target or stop loss. Okay, so this is also a very critical portion. The fourth most important thing, which probably till now has not come to the surface, but right now because of the margining system it's becoming very important, is what is the capital outlay, then return on investment. We should make this analysis properly and then tell them that no, see, the question is not only the profit, okay, the question is for the amount that you have put, for the risk that you are taking, what is the return that you are getting. So now let us say I am taking for an understanding purpose, if I am taking 1 rupee risk and earning 2 rupees profit, is it not better than taking 2 rupees risk and then earning 1 rupee profit? So question is that how much of risk that you are going to take, how much of reward that is going to come, all those things matters, right? So the capital outlay is also important, and hence the return on investment is very important. Now, this session is going to focus more on this aspect, because these aspects we are now leave it to the trader, or probably those who are giving their views and recommendations. Probably they will be giving buy and losing. So with that we will keep it at a later stage. So our main focus today is basically how to enhance the return on investment and how to use options in that particular case. So right now when we show examples, we will consider as if somebody is a buyer or somebody is a seller. Okay, so we will more look towards let us say a buyer of a future. So if a buyer of a future, what normally is the capital that is required, and what is the present problem, and how to overcome that problem. Okay, now let's straight away go to the most important index which is traded, Nifty. I think this is the maximum traded as far as the futures is concerned, right? Nifty futures and then Bank Nifty futures. These are most sought after. Maybe a little bit of conservative investor may go for Nifty futures, and more aggressive trader normally goes for Bank Nifty because of the volatility that is there in this. So Nifty right now, if you look at the margining system, now the margining system consists of span, exposure margin, then of course comes the MTM, right? So this is the span, exposure and MTM. Now in this, of course, MTM depends on the loss or the profit. So this is something, if there is a 2% down compared to yesterday for having bought, then extra 2% comes. So right now it is not an upfront money, right? So as the market, as it progresses, then we have an MTM issue. So now this is the this is for the futures, right? So the span margin is the most significant of all. The most significant of the entire margining system will come in span, because that is the amount of risk that on for a single day on a 99.5% consideration, NSE calculates that how much of risk is there. So now if you look at the exposure margin, this is almost fixed. This is fixed in the sense that for the index, exposure margin is 2% of contract value. Is 2% of contract value. So this is 2% of contract value, means what is the Nifty value today? Nifty value, let us say, is 16,500 approximately. Then into 50. Now it's the quantity is 50. So the value of Nifty is 8.25 lakhs. Value, approximate value of one Nifty contracts is 8.25 lakhs. And the total amount of margin that is required right now is around 1.06 lakhs. That is 1,06,000. So let's round it off to 1,10,000 is the margin that is required as far as Nifty is concerned. In that, what is the exposure margin? It is only 2% of the contract value, which means approximately it will come to around say 17,000. I'm giving an approximate example. So the remaining is only span margin, which means more than 90,000 rupees will come as a span margin. So it is a span margin which is going to consume the bulk of the margin requirement, and in any particular trading we may have the exposure margin unless we only go for buying of the option. So now we will illustrate one or two examples to show that how the futures thing can be just replicated by an option with very less investment, with only 15 to 20% of this amount. So if you want to do a futures today, the amount of money that is required today is 1,06,000. Now I am going to illustrate to you that we may not need 1,06,000. We may even go for approximately, for position trading, we can even go for 20,000 rupees. Even 20,000 means at 20% of the full margin that is required for the futures, or even less than that we can do. That means it itself comes to 5 to 6 times of the margin that we are going to give, right? One. Second thing, for intraday trading, we can even go for much lower amount. Okay, we may even go for much lower amount, which will come to almost 10 times the exposure. So I will tell you how both these things are possible. Now let us say if you are doing an intraday trading, because there is in this I want to make it clear that intraday, in the case of intraday trading, we have to consider it slightly different from position trading in terms of choosing of the option. Now, the benefit of the option I will tell you, and what sort of a strike we should use both for the intraday as well as for the position trading, I will highlight to you. Now, this is the amount that is required. Now, let us say you are going to buy an option. Now, I don't want to explain to what is an option because I think you may be already aware of it. So, I'm going to illustrate. Now, we are going to buy a call option, which is a replacement for buying futures, right? Instead of buying a futures, you are going to buy a call. Now, let us look at, let us plainly look at, first of all, intraday trading. Okay, for the moment, I'm not saying whether you should be a buyer or a seller. I'm just saying that if you are a buyer, what's the case? And you're going to cut the position intraday itself. Okay, so we will keep it like this. Now, my recommendation is that now because the difference between position and intraday has completely blurred with the margining system gone. So, if somebody wants to carry on the position, I would definitely advise them to carry on the position. But only choice is that which strike option that you should be there. Okay, for which we have had a lot of webinars for our clients in the last few months, and we continue to have that. Now, in this case, let us say 16,000, probably it closed at 16,550 or so, right? So, yesterday it was around, it came closer to that particular price. So, now let us say tomorrow the market opens. Okay, let us look at what is the, this Thursday today, the expiry was yesterday because of holiday today. So, now we have to look at the next week, which is 26th. So, let us look at the week, 26th week. What is the at the money option price? At the money option price. Okay, at the money option price. What is the option premium? Now, you're familiar now with the, we can go to the option chain in NSE, and this is of course in white background, so I will read it out for you. So, 16,000 approximately the market is between 16,550 and 16,600. So, let me say 16,550 right now, and the call option price is 104 rupees. Call option price is 104 rupees. Okay. Now, so when you choose at the money, now what somebody wants is, he wants something like a futures. He wants something like a, that is the risk reward in the case of intraday trading should be something like a futures plus or minus something. Okay, that plus or minus, I don't want to confuse you with what that plus or minus is, because those are characteristics of the option in terms of the volatility. I'm not going into all those things because that is not the major point that we need to stress today. So, right now we are looking at the capital outlay. So, let us say 16,550 is 105 rupees and you are at the money. So, if you are at the money option, if you choose, and if you want to have something like a futures risk reward, then you should go for 2 contracts of at the money option. 2 contracts of at the money option. Okay. For 2 contracts means 105 rupees. If you're going for, if you want to buy for 105 rupees, what is the amount of investment that is there? 105 into 50, that is the quantity right now in Nifty, into 2 lots, right? So, that comes to 10,500. This is the amount that is required, not 1,06,000, which is the amount that is required for futures. So, it is only 10%. That means, on intraday trading, you are already giving 10 times exposure. 10 times exposure. Okay. And question is that in the previous time, he has to cut the position by 315. Okay. Now, we don't have the disadvantage of cutting the position. If he wants to carry, let him carry. The investor wants to carry, trader wants to carry the position, he can carry, because next, assuming he bought it and the market has already added by 200 points, he is already a gain. Probably he would like to carry the position. In the previous time, then he had to bring that 1,06,000. Now he has already put that money, finished there. So, no question of further MTMs. No need for us to look towards having a system where we need to cut off the position. It saves up time, and it tells the customer that, see, you have you don't have suffer disadvantage of carrying over the position in case for a profitable position you want to carry, And second thing, look at the amount that you need to put it, which is as good as what you are getting before at 10 times. If you are giving 10 times, right? It may be even better than most of what others were giving before also. So this is what they should have done even previously. So this is at the money option that if you want, you can do that. Now, suppose if you want to probably have one position, this one, because you want to make it like a futures, and if you want to carry forward the position, let us say you do not know by the end of the day whether you want to carry forward the position or not, because option buying has one disadvantage in terms of time decay, volatility and all those things if it goes against you. So that can be negated by going for slightly deep in the money option. Now I have chosen at the money option, which can be used for trading the for intraday. Alternative is that you can go for slightly deep in the money, and let us say if it is 16,550 levels, assuming that you are going for 16,000 call also. Even if you are going for 16,000 call, let's say what it is. So 16,000 call is 567. So 567, 565 or so, which will be something exactly like a futures, because the time value is very less. So you want to carry forward the position and you don't want to suffer any disadvantage of an option thing, then this will be ideal. So this will come some 26,000 rupees or so for overnight carrying of the position, and you will not have any disadvantages of an option volatility or the time decay. All those things will not be there. So this is still only 25% of the amount that is required there. So if you want, if for intraday trading, you can go and advise them for other money. Okay, there will be some there are some traders who will look at whether there is a time decay within that particular day, some small amount loss or nothing. Possibly yes, on some days it can be there, sometimes it may not be there. But the question there is that some small compromises on some characteristics of option compared to the total outlay that is required as far as the capital is concerned. So our first point is to stress mainly on the capital. Okay, so once they work on that, they will know which option strike to choose or what it is. So the alternate thing is that you don't want to suffer from that. The maximum could be this, or probably you can even cut down and make it at 16,200 option also. Because the reason why I am saying this, whether you go for this, is that if you are a trader, okay, now you will definitely look at some sort of technical parameters to take profit or cut positions. Not that you will be holding the position in a passive manner, right? You will not be holding the position in a very passive manner. That is for an investor to do. So if I am an investor, okay, I am not a trader. If I am an investor, I will go for 16,000. So even for an investor, that is what we are going to come to the next position. If I am an investor, I would have probably put a little bit of money for 26,000 rupees and for 16,000, right? But an investor, actually, if you had put the money in a cash market, you would have put 8,75,000 for this. So if there is an investor who is going to put 8,75,000, instead of 8,75,000 in the case of Nifty, you can ask them to put for 26,000 rupees and get the same advantages and disadvantage for an 8,75,000 contract. It's only 3 to 4% of the amount that is required for cash market investment, right? So when compared to cash market investment, such a Nifty thing is going to offer enormous advantages in terms of reducing the capital outlay. Even in the case of a futures, okay, if you're doing for the futures, one advantage is that you are going to trade with only less than approximately 25% of the capital that is required for the futures with this. In the case of intraday trading, you are going to come to at the money option and trade at only at almost at 10 times exposure, I think, by going only for 10. Now I am talking about this is for 1 week before. Let us say somebody who is going to do only 2 days before. Let us say intraday traders are coming, and let us say if I am on Wednesday, okay, for a Thursday expiry, I am on Wednesday, I am doing an intraday trading. Now for Wednesday and Thursday means it will not be even 100 rupees, it may be only 40 or 50 rupees. Say suppose on Wednesday for a Thursday trade, this will be only 50 rupees, the option price, approximately I am saying, the same 100 rupees, maybe only 50 rupees. That means the amount of capital that is required is 5,000. 5,000. So for one full week it starts at 10 times exposure, and as days near the expiry it is going to come to 20 times exposure. So on Wednesday you are going to have only 5,000 rupees to trade 1 lakh. So on Wednesday and Thursday and all, it will be even less. It will be only at 40 rupees or 30 rupees. Okay, intraday trading. So intraday trading on Wednesday and Thursday, even on Tuesday, as days progress, it will come less. Even on Monday, if you look at it, Monday it will be 75 rupees. That means the amount of required will come down from 10,000 to 7,500. This is subject to some small changes depending on the volatility. Right now it is like this. So 10,000, 10K, it may come to 7.5K on Monday, it may come to 5,000 on Wednesday, and it can come to 4,000 rupees on Thursday. So as days progress, we are going to get lesser and lesser amount of capital that is required. So if somebody has even traded like this, he can even look towards, probably, see, another thing is that, let us say he has bought today and the price rallies completely from 16,550 to 16,850 levels. But still his investment would have been only this much of amount. That is what amount that he has put on that day, right? So what he has to just do is, let us say by next Thursday it rallies to 6,850. He is going to take the profit because technically I think his position has been kept alive. There is no change for taking the profit. So what he will do is that he will close the contract, then again take the trade on Thursday. So we are doing a weekly option. Now what is the advantage for us? Now advantage for us is we have convinced the client that probably we are going to have less amount of money. Second advantage for us is the business, because every Thursday, Wednesday, on Thursday, even if the trade is alive, he is going to cut that trade and take a new trade for next Thursday. So our business is also assured. And in the normal intraday trading anyway, or positional trading, if there are signals which tells them to take profit or stop loss, they would have done that in the normal manner. So this is the whatever that we are showing applies even for Bank Nifty, futures and commodities. We will show examples of each one of that. Now, as far as Bank Nifty is concerned, the same thing. Bank Nifty, we have got say 25 units, right? 25 units, and presently it is say 35,500. So the value of the contract right now is 8.87 lakhs. Okay. In this, the total amount of margin that is required is approximately 1.6 lakhs. That is both span and margin, span and exposure margin. Now, the exposure margin is going to come only at 2%, which is approximately 17,000 rupees. So the remaining is consumed only by the span margin. So should we have that much of an amount? We don't need that much of an amount. Okay. What we are going to do is that we are going to do basically an option. Let us say 35,500. Now market close at 35,500 option. So let's look at the option price now for Bank Nifty. See, here 35,026, right? So Bank Nifty, sorry, 26th. So okay, now we are approximately at 35,600 or 35,500. So 35,500 is around 345 rupees. So 345 is the amount that is required. Those who want to do intraday, let us say 350, and this will go down progressively. 350 into 25 into 2, right? So approximately it will come to 17,500 rupees. Approximately. Now, where does this compare with 1.6 lakhs? Same time, 10%, less than 10%, and it is going to keep coming down. So if you go for intraday, this one for intraday trading, you can go at the money 2 contracts, which is equivalent to future, and put only this much of money instead of this. So in case of Bank Nifty also, it is the same case as of the Nifty is concerned. Okay. Now we will look at the scrip commodity, then we will look at a spread contract in the case of Nifty and how the execution should happen, right? So in the case of let us say Reliance is, let us say, 250 units. Now approximately 2,100 rupees is the price and 5.25 lakhs is the value of the contract, and the margin that may be required right now is 1.2 lakhs for this. 1.2 is the margin that is required. In the case of stocks, the exposure margin is 3.5%. So this may come something like 18,000 rupees or so approximately as an exposure margin. Now here do we require 1.2? Now let us look at Reliance. What is the Reliance price and look at the option value in Reliance. Okay, now Reliance for next week is going, let us say 2180 approximately price, and the option price is something like 22 rupees for 2180 call option. So 22 rupees is on 250, right? 250 is the lot size there. Yeah, 250. So 22 into 250. So what we required here, 250 into 2, around 10,000 rupees. Same thing like Nifty. Instead of 1.2 lakhs, you just need 10,000 in this to do an intraday trading in Reliance. Approximately around 8 to 10% of the futures margin, which means approximately 10 times of exposure by doing this activity here. Right. So the moment if you look at intraday trading, you can advise for at the money option and 2 contracts of at the money option equal to 1 futures at almost 10 times exposure automatically comes in. As the week progresses, it is even going to be much higher exposure like thing. But the risk reward is going to be the same like the futures. But there is an advantage. I tell you what is the advantage. Now if by chance during the course of the intraday itself, Reliance falls by 100 rupees. In the futures you will suffer 100 rupees into 250. So 25,000 rupees will be gone. But here how much will be gone? It's only approximately 20 into 250, it will be only 10,000. So instead of 25,000, the maximum loss will be 10,000. Let us say for some news comes and Reliance suddenly drops down, okay, by 100 rupees. Still this will have some value. 22 rupees may have a value of 7 or 8 rupees. So you might suffer some 6,000-7,000 rupees loss as against 25,000 rupees loss there. So that way, even during intraday trading, if there is big negative news, the option trading can protect you compared to a futures. Compared to a futures, because suddenly you see, even in market, suddenly you see a big drop coming. On some days you can see a big drop coming. So instead of suffering from that, you can always suffer less, even if there is a loss comes in the case of an option trading. So that is an advantage. Even if you are going for the position trading, in the case of overnight, you do not know what will happen, right? During pandemic times and all, we never knew what will happen the next day. Similarly, a lot of big bad news comes overnight, and most of the big losses are suffered overnight because of some uncertain development which takes place. In those cases also, whether you took a deep in the money option or at the money option, they are much safer when compared to the futures. So as far as risk mitigation is concerned, we are already aware of it. So that is the extra benefit that we are getting by doing this. So it's not only reducing our margin, it is also a risk mitigation tool. Now, before we go to the spread option, I will highlight to you what happens as far as commodity option also is concerned, and then we will switch over to the spread option type. Now, commodity, we have the crude, right? So crude maybe is going at 4,900 rupees or so, and the value of the contract is 4.9 lakhs, and the margin required is 1.2 lakhs right now, right? So the NRML is 1.2 lakhs is the margin required. Now, As against this, the 4,900 option, call option, let us say you want to buy 4,900 call option is going at 190 rupees or so, 190 rupees, and this into value is 100, right? So you may need 19,000 to 20,000 rupees is the value that is required instead of 1.2. So approximately, no, you will have say 15% of the amount that is required to trade the option as far as crude is concerned. So here also you make a considerable amount of saving by going in for option trading rather than the futures, because in futures you are required to put 1.2 lakhs for the value of the contract, which a lot of people may not have, or probably then in that case they will be quite nervous. Then there is a chance that they may leave the trade in case if they make a loss, okay, or probably they will keep the loss to a substantial extent that it will get eroded. But here at least we know that the maximum loss is going to be something like 19 to 20,000 rupees loss, okay. So to some extent they are protecting themselves at the maximum, see, because 190, 200 rupees and all in crude can just like that go off. So I think it is much more safer to trade in option in crude rather than even in Nifty, because in Nifty at least there is a chance that it will recover. So even the futures can be a little bit safe. Forget about the money part of it, but at least you can roll over and come back. But as far as crude is concerned, you never know what levels, whether this will all come back or not. So in those particular cases, it is better even much to go for option trading, whether it is intraday, because in intraday, particularly in the evening time, on those days when the inventory details are released, or particularly the volatility is between 7 and 9, and during that particular time the crude oscillates in a big manner. So in those particular cases, definitely going in for an option which are the money, because in the case of crude, particularly in commodities, option is not that liquid when compared to index, equity indices or equities. So to that extent, we should not look towards any other option other than what is there near the futures, that is at the money. So at present, in case of commodities, it is better to stick only with at the money option. Assuming somebody has made money, okay, in case of crude, let us say, you need to be careful about this compared to index. The one point of caution that I want to say is, suppose if the market rallies from 4900 to 5200, let us say, or it has fallen down to 4700, whatever it is, the moment it goes to some other higher price, better to switch the strike, because the moment it moves away from that particular strike, that strike will suffer from liquidity. For example, right now, let us say if you look at 4,500 call option, that may not have the same liquidity which is at 4,900, because in India the commodity option is still not developed to that extent. So very clearly we focus that in the case of commodity right now, look at the money option only. So at the money option on that particular day, plus or minus 100 rupees, not a problem intraday. But suppose if somebody is carrying the position, then in that case 1 or 2 days later on, even if he makes money and if it's at 5200 or 5300, then please advise to ensure that he rolls over that particular position to something which is very closer to the strike. There is additional benefit for us, we get additional brokerage because of that, but we are telling this only in the interest of the client. What we are getting is incidental. Okay, so this is as far as crude is concerned. So we have illustrated clearly that margining, present margining is much more favorable and gives us something like 10 to 20 times exposure by doing at the money option in the case of intraday trading, and better for those who are doing position trading to slight or investment to consider slightly deep in the money option to avoid some of the negative impact of option Greeks. Now we will look at the spread option. See, what is a spread option? Now spread option is what basically the SEBI and NSE has done is that if you are an hedger, they want to remove the unnecessary margin. The only margin that is charged is the exposure margin. So what they do is that they charge the exposure margin plus the risk. So what happens is that if you are taking a risk in an option, in a spread contract also, you may be taking some risk. So what they want to do is that that risk amount is calculated upfront plus the exposure margin. So exposure margin will always be there unless you are a plain buyer of a call or put. Plain buying a call or put, we have buying of a call we have already illustrated. Now let us look at what is a spread option. Now let us say Nifty futures is 16,550. If I am buying a 16,550 call, okay, and I am selling a 16,750 call, let us say, I'm doing this trade. This is a spread option, because spread means you should have more than one leg. So there is a buy leg and there is a sell leg. Now, one thing is that this is 16,550, 16,750. So I'm buying a lower strike and selling a higher strike, right? So in this case, I don't have any risk, because if the market goes up, then I have a first leg which is more profitable than the loss in the second leg. So the NSE doesn't need to charge me the margin for this. Okay. So what they will do is, they will just calculate the span margin and take the premium from you. So let us look at what is the premium and the margin that we have to pay. Exposure margin will always come. So exposure margin, I told you, is 2% of the contract value, and 2% of the contract value in Nifty is 8.25 into 2 is 16,500. So for this, the exposure margin will come at 16,500. That is all. Plus the premium amount that is collected from us, and the premium amount will be for 16,550 we have seen is 104 rupees, and 16,750 we'll see what it is right now. 16,550 is 105 and 16,750 is 28. So approximately let us say 75 rupees or so. So 75 into 50 will be 3,750. So that amount will be upfront collected from us. So 3,750 is the premium amount that will be collected from us. Okay. So that's the amount that we pay, plus this exposure margin of 16,500, which means we will pay something like a 20,000 rupees, which means we will pay for this spread contract, we will pay 20,000 rupees. Now what is very important while doing a spread contract? Now this is the trade which tells you that you just need to pay only 20,000 rupees for the spread contract and not more than that. Okay, that is because of the premium amount plus this margin. But while execution, one has to be very careful as far as executing these trades are concerned, because first of all the system will calculate whether you have already got a buy portion before the sell portion advantage is given. Because first of all, the sell, if you do only a naked sell position, then in that case the margin will come as if like a futures, something very closer to the futures will come. But suppose if it in the your trade book, in the accounts, you don't have the required amount of margin, the trade will not get executed. Okay, so at least to that extent, the trade will not get executed. But you may be wondering as to why the trade is not executed. That is the portion. So first of all, what you have to do is, while executing a spread contract, which is of this margin only, then first of all you should look towards buy portion. Okay, so what you should do is that you should execute the buy portion, and then you should do the sell portion. If you do the buy portion and then you do the sell portion, then it will calculate that the amount of money that you require is only 16,500 for the exposure, plus that additional amount of 3,750 that is required in your account to debit for the net premium amount that is to be paid. So approximately 20,000 rupees, and no further MTM, no issues, nothing. So wherever the market goes, this exposure margin will get released to you after some time. So this is not a loss. The maximum loss is going to be only some 3,750 or so. So you can wait and see how things work for a week or so, and then realize the full amount of profit also. That's also possible. Or you want to tinker with it some stage, you can tinker with it. But essentially, while executing the trade, you need to be careful, because a lot of clients can complain that trade is not going through. Okay, because they might have done the sell portion first, and then probably they are not in a position to do the buy portion, and doing the sell portion, the trade would not have gone through, because it would have been searching for a 1 lakh plus margin amount, but in the amount only 20,000 rupees would have been there. So they will be complaining, saying, sir, you said only 20,000 rupees, but now execution is not executing it. So it is important for us to also understand, and also to tell our clients that if you are doing a spread trade, please, while putting the trade, okay, while first initializing the trade, you should do a buy trade and then a sell trade. Now the opposite should happen while winding up the contract, because while winding up the contract, if you wind up the buy side, let us say at some stage you want to take the profit. If you wind up the buy side, okay, then the sell side immediately it will calculate the option. Okay, immediately it will calculate whether you have the margin, okay, which you may not have in the trade. So what you should do is that you should first wind up, okay, the sell side. So while putting the trade, you should do the buy trade, and while unwinding the trade, that is while removing the trade, first remove the sell side. Okay, then buy side only will be there, and then you can remove the buy side. Okay, that's one. Or if you feel that the market continues to move up, continues to go up, and so you want to keep the buy side and you don't want to keep the sell side. For example, let us say the market is at 16,850. You get a feeling right now it is still going to go up. So probably you can just wind up the sell side and keep going with the buy side also. That's possible. But if you want to wind up the entire trade, then in that case you should wind up the sell side and then you should do the buy side winding up. So this is the way you should adopt this particular spread trade. And if you are doing a spread trade like this, what is the margin that will come? Let us say put spread. Let us say I'm saying that I will sell 16,550 put. Okay, I'm going to sell side and I'm buying a 16,350 put. Let us say you're doing this particular trade. Okay, now while doing this particular trade also, you should do the buy side first and then you should do the sell side. Okay, now let us say the difference here, what is the maximum loss that, because if the market goes down, what is the maximum loss that you can incur? The maximum loss that you can incur is something like 200 rupees, right? So 200 it will take, span margin will be calculated 200 into 50 minus the premium that you are receiving. Okay, so let us say 16,550 put is 96 and 16,350 is 36. So 60 rupees you are getting there. Okay, so 60 rupees you are getting minus 200 into 50 is 10,000. 60 rupees is the premium that you are getting. So you will be given the benefit of this. So the span margin will be calculated as the maximum risk of 200 into 50, 10,000 minus the premium, the amount that is due to you because of doing this contract. So the span margin will become 7,000. And the exposure margin, which I told you, is the same 2% of the contract value, which could be some 16,000 or so. So the total margin that will be required is some 23,000 rupees. And for 23,000 rupees, if the trade goes through properly, then you get 3,000 rupees, and 3,000 rupees on 23,000 rupees is a fabulous profit. The return on investment is very high. Okay, which is approximately we can say 15% or so per week. So that's still a very fabulous amount of return. Now I told you one important portion before we wind up is the return on investment. Now when we talked about like something like the futures, okay, now let us say you today the profit you got in futures is say 50 rupees. Okay, in the normal case, in how much you have got? 2,500 rupees, right? For an investment which is say 1 lakh in the case of futures. So what is the return that you got is 2.5%. 2.5%, right? So in the case of options, what is it that you have got? You have got the same 50 rupees in that thing because you have got 2 contracts. So the same 2,500 rupees would have been the profit. But what is the investment? It is 10,000. So what is the thing? It is 25%. So you get almost the same type of exposure that you get is the same type of return on investment that you get. But all other things are applicable, because if you're going to put a stop loss in futures, you're going to put the same stop loss as far as the options also is concerned. So that way the risk reward is going to be the same. Okay. Question there is whenever you get a profit, because overall the trading you're going to do is to make profits. So whenever you make a profit, that return on investment that you get because of the profit made will be higher, much higher in case of an option trading rather than the futures trading. But only thing is you have to ensure that you do certain things consistently, which is a very important part of a trading plan, whether you are going to put any particular system in place or whether you have a knack of doing whatever way you're going to do that. Once you know that you are doing this either for investment or for trading and you can make it profitable, then in that case, if you can have the ability to make the profit, okay, then option is the best course in order to ensure that the return on investment is higher. And any trader who wishes to come in the market wishes to trade profitably. So either you learn it or learn it from others, or you learn the skill. So while learning the skill, you should also ensure that his losses are kept to a minimal, which again the option facilitates. So this is the basic understanding that we need to have. And the main focus today is don't have a problem of the capital. The capital which you enjoyed, the margin that you enjoyed is in no way different from the amount of premium that you are going to pay now, and it comes with additional facility of rolling over the position without creating additional margin for overnight positions, without MTM problems, and risk mitigation and return on investment. What more you want? So the client has to be made more confident of coming into the option, and probably if he has certain reservations about certain characteristics of the option, you should be encouraged to attend some webinars or look at some reading in order to get more familiar with how you should trade the option. Other than that, the trading signals that is generated is the same. Okay, so the trading signals, we are not getting into it. It is up to the investor or up to the chartist to say whether he is a buyer or seller. Once the buying or selling is picked up, then what should be done? That is where we focus today. Okay, so thanks for the thing. Now it's 11:50. So next 10 minutes we can have for question answer session. So I would welcome your questions. Probably you may have a lot of questions. Let's see how much we can answer in the next 10-15 minutes of time. Thank you. I'm sure you will have questions because it's an internal thing, so you are free to ask your questions. I hope you are clear with how the margins are being calculated now, okay, and what exposure margin they are charging right now, and how options are beneficial. And so question is that we need to clearly promote option to ensure that the margining problem is over. Since questions are not coming, can I presume that you are very clear on what has been discussed? I'm happy, I'll be very happy if you can give me a feedback whether there is some problem in understanding or what subject we have not touched, or whether there is any missing thing. What is the peak margin? Peak margin is the span and exposure margin will always be there. The peak margin will come with additional of MTMs, whatever that you have. So the margin system is based. You are aware of that the exposure margin is always fixed. Okay, the span margin will depend on the volatility. So that we can't say the span. This is the amount of margin. Tomorrow, if Nifty is going to be extremely volatile, then in that case, the margin can be different from what it is right now. If the volatility comes down, probably it may be slightly low. If the volatility goes up, it can be higher. Plus or minus another 10% or swing you can expect as far as the margin is concerned. Any questions on options, spread options? Why we should use spread options? Why we should use the money options? So you have to basically think of how you are going to market it, how you are going to structure to market it to the clients. What is it that you're going to say? I think the advantage that we should have, because a lot of people will be aware of it, a lot of people will try to market it also. But what is it that we should do in order to capture the attention of the investor and make them confident? That is where a thing will be there. How to choose the strike while expiry day intraday option trading, sir? How to choose strike while expiry intraday option? Now, see clearly, if it is an intraday for expiry day, on expiry day, let us say the market is 16,550. If it goes up and down, and it closes at 16,550, you lose the entire amount. You lose the entire amount, right? Now, on that day, probably at the start of the day, somebody wants to buy, the option premium will be only some 40 rupees or so, right? So, question is that you will lose 40 rupees if it comes exactly closes at the same rate. But whereas in the case of futures, you may not lose that amount. So, what is exactly the characteristic? Because if he wants to go general swing in the market between open and the close, generally will not be more than approximately 80-90 rupees between the open and the close rate, I am saying, most of the time. So, if he chooses something like 2 times of at the money of 40 rupees or so, unless the market makes a swing which is more than 80 points from the open, okay, then and he doesn't do anything, then option would have been more beneficial than futures. Since that is going to be only in 10-15% of the cases, on expiry day, it is better for him to choose a strike which is 100 points away from the market rate. Now, let us say if it is trading at 16,550, open at 16,550, he expects the market to go up. Then in that case, you buy a 16,450 or something like that. So, the amount that you will be paying is, instead of 100 rupees, you will be paying 110 rupees. Okay, the difference will be, so maximum the time decay probably for the rest of the day could be around 10 rupees or so. And when it goes up, you will get the same benefit like a futures, except for this 10 rupees, which is extra that amount that he has paid, which comes with 110 into 50, which will be only some 5,000 rupees or so, maybe the requirement of capital. Okay, so better to choose something like 100 rupees away from the price at which the market is trading. On expiry day also you can do with the spread contract, you can do, yes, the spread contract you can do till such time the option expiry comes. So, even at 3 o'clock, if you see at 2:30 also, normally at the money price will be going something like 20 rupees or so, even 1 hour before will be going at 20 rupees or so. It will decay very fast just 1 hour before the expiry. Okay. So, up to 1 hour also the price will be going up around 20 rupees. For half an hour it will be going at some 10-15 rupees or so. So, the hedging can be done till the last period of say 3:15 or 3 o'clock. It's also. If trend is going up down, how to trade? No, if trend is going up down, how to trade is see, we must have some system of because if there is a perfect system of getting all over the problem, then there will be a system which everybody will be using to make money. So, that is always a problem as far as because even if you have some systems which works well on trend may not work well when the market goes sideways. What works in sideways may not go. So, there may be some systems which can filter all those noises, but probably it cannot take that many trades. So, there has to be some compromises on that. So, what compromise that we are going to make will depend on our personality. So, if the system, if it keeps going up and down, okay, then in that case, that particular volatility, we must know how to take the profits at the earliest, because if you do something and it goes up and then looks like coming down, then we should be in a position to take the profit. So, that has to come from your reading of the chart. Now, one probably, for example, I can tell you, say Nifty, if it is there. Generally, in an intraday, normally if the swing takes place more than 45 to 50 points, then in that case it swings a little bit more. So, let us say it goes from 16,600 to 16,700, then it starts falling below 16,650 or so. It looks as it may look as if for the day the trend is made. I mean, like no, it will not go up. That's a general calculation that we have seen. Similarly, in Bank Nifty, it's around 200 rupees or so from high to low. So, these are studies which have been done from looking at the chart. So, each one has to have their own way of understanding how that works and then put in the trade. So, that is the skill of a particular trader. Or there are systems right now. No? You have a lot of algos and a lot of other systems. Probably you can use all those things also to trade beneficially. See, strategy, profitable intraday or carry forward. Carry forward, because of the jumps which happens overnight, okay, the carry forward has an advantage if the jump happens in our favor, okay, if you are on the bull. Now, one thing is that as far as index is concerned, it is always unless except for some specific times, it is better to be on the long side. The long side generally gives more money than the short side, and the short side normally happens to be quite swift, and you have to take the fast profit fast. So the carry forward in case of an uptrend is always useful on the bull side. On the bullish side, it is better to carry forward if the signal is on the upside. So sometimes it may work the other side, that no, probably it is looking quite bullish, so you might have carry forward the position, but next day you see the market coming down. Okay, so there will be always be conflict, thinking that it is whether it would have been better to cut off the intraday itself, and better no, we could have come out of the trade and probably the next day we could have entered. So sometimes it will be like that. Sometimes you feel it is better that no, there was a 50 to 75 points on the upside, so it would have been better if I had kept the position. So these things will, it's something which we cannot say perfectly that it is better to carry forward or intraday. And my suggestion is that those who want to make big money generally don't do major profits in intraday, okay, because you have a system, then the intraday normally will have not much of a trend, because it can go up and down, go up and down. So the chart in a intraday can be a little more confused, but the bigger chart will be much more clear. So those who want to trade, make more money, generally by having less positions, but probably look towards carry forward the position and make money by keeping positions intact and not minding certain amount of fall. So anything further if you have also regarding the margining system, I request you to think about it, and probably if you have any queries on this, you can please forward it and we will try to answer that. And if there are still doubts, we will again answer it at some stage. And also since you will be meeting your clients, customers, you can get feedback from what you are saying to them and probably post it, and so that we will look at where the difficulties come. And I know, because certain things we have said right now, so it is for you to absorb it, communicate to the clients, and what difficulties they face. We will see whether the difficulties are coming because of execution problems or because of some other reason. So we will try to sort it out, whether it could be an understanding problem or whether it could be due to some other issues. So we will try to sort it out. So the only thing is that I hope this webinar has achieved the objective of convincing you that there is a great advantage of shifting to option, and there is no disadvantage in the margining system if you shift to option. That is what you need to convey to the client, whether it is in index, equities or commodities. Thank you very much for your participation. Thank you. Bye.